Here's the truth that wipes out more traders than any bad market. And it's a truth so brutally simple that most people spend their entire trading careers trying to avoid it. You don't miss the biggest market moves because you're late. You miss them because you're too exposed and too emotionally fragile to survive long enough for the real move to unfold. That's the paradox amateurs never understand. The paradox that sits beneath almost every blown account and every aborted trend. Amateurs want the big win so badly that they load the moment they feel excitement, but professionals want the big trend. So they begin with the smallest possible position that allows them to stay alive, think clearly, and watch the tape without fear. Livermore knew this better than anyone who ever speculated. When he said, "The big money is made in the sitting," he was revealing half the rule. The more important half, the hidden half that he practiced quietly, was this: you can only sit if your risk is tiny enough to keep fear silent. Look at any blown-up trader and you'll see the same sequence repeated like an unbreakable script. They enter early, they size too large, they pray their conviction becomes reality, and when the tape nudges against them, they panic because their risk is oversized and their identity is fragile. But the professional enters light, like a scout stepping ahead of the main army. A single share, a single probe, a single test of the tape. Not to make money, but to measure whether the market is inviting size or punishing arrogance. This is the part amateurs never grasp. The first position isn't supposed to make you rich. It's supposed to keep you neutral, attentive, and emotionally unbound. When you size small, your mind stays clear. When your mind stays clear, you can observe. And when you observe long enough, you finally see the pivotal point forming, the moment when a market stops acting random and starts acting directional. That's the Livermore hack we're unraveling here. The hidden behavior of professionals who seem to sense big moves in advance but are actually just patient enough and small enough to witness them forming. Today's amateurs chase comfort. They chase the feeling of being in, the comfort of holding a position that feels meaningful. Professionals chase confirmation. They're willing to wait through boredom, hesitation, inside hesitation, because they know the market eventually reveals whether it intends to trend or intends to trap. And yet the deeper mystery, the mystery we'll solve later, is why a small initial position often predicts the biggest eventual gain. It sounds contradictory, even ridiculous. How can something so small be the seed of something enormous? The answer sits at the core of catching massive moves with minimal risk. And it's a rule so counterintuitive that most traders ignore it and then blame the market for their failure. Because the truth is this: small size isn't weakness. Small size is survival. When you start small, you buy time. When you have time, you can watch for behavior. When you watch behavior, you gather proof. And when you gather proof, you catch the move not by guessing, but by aligning. This is the psychological pivot amateurs never take, because their identity is wrapped in the need to be right immediately, while the professional's identity is built on the need to survive long enough to get right sustainably. Think about the last time you took a big position. Did you do it because the market was offering clear confirmation, or did you do it because you wanted to feel certain? That internal pressure to feel certain is precisely what forces amateurs into oversized trades, and oversized trades are exactly what blind them. Fear creates noise. Noise overrides tape. Tape hides pivotal points. The spiral is inevitable. Professionals break that spiral by refusing to begin with size. They begin with a scout entry, a concept we'll deepen later, but for now, know this: the scout is the antidote to emotional distortion. It's the first step toward objectivity. It's the leverage-free eye that watches the tape without shaking hands. And here's the most counterintuitive layer. When you reduce size, you don't reduce opportunity. You increase it. Because the opportunity that matters isn't the first dollars you make. It's the insight you gain by staying long enough to identify whether the move forming beneath you has the potential to become the one trend that pays for the entire campaign. Traders who blow up don't blow up because of bad markets. They blow up because they size prematurely. They size emotionally. and they refuse to treat the beginning of a trade as reconnaissance. Every professional knows that the market rarely moves cleanly from the start. Early action is messy, frustrating, and filled with noise. But the scout position is built to survive that noise, to endure the impatience, and to keep the trader aligned with reality instead of fantasy. The scout is your psychological stabilizer, your emotional insurance policy, your access pass to clarity, and clarity is everything. The clearer your mind, the more you notice the subtle cues, the pullback that doesn't quite break, the rally that shows reduced volatility, the moment when sellers push but cannot push far. These cues are invisible to the oversized amateur who is too busy wrestling anxiety to see anything at all. But they are visible to the lightly exposed professional who is watching with a calm nervous system and a clean ledger. This is why starting small leads to catching the biggest moves, because the biggest moves require patience, and patience requires peace, and peace requires small risk. The mathematics are simple but profound. The smaller your initial risk, the longer you can hold. The longer you can hold, the more confirmation you gather. The more confirmation you gather, the more size you can earn. The more size you earn, the more you participate in the real trend, rather than the noise pretending to be one. This chapter opens with that painful truth because it sets the stakes for everything that follows. It frames the amateur versus the professional not as a difference in intelligence, but as a difference in identity, behavior, and emotional architecture. Amateurs size big to feel certain. Professionals size tiny to earn certainty. Amateurs chase immediacy. Professionals chase confirmation. Amateurs think their first position must be right. Professionals know their first position must be survivable. And it is in that difference, subtle, psychological, structural, that every large gain or catastrophic loss is determined ahead of time. A key Livermore insight anchors all of it. The big money is made in the sitting, but sitting is impossible when fear is activated by large risk. The scout entry is introduced here not as a tactic, but as a philosophy of survival, clarity, and patient observation. It is the first building block in a structure designed to catch the largest possible move with the smallest possible initial risk. And that is the central mystery of this entire lesson. Why does starting small often lead to catching the biggest move? The answer is coming, piece by piece, rule by rule, confirmation by confirmation. This first chapter is the doorway. The real transformation begins when you understand how the scout flips the entire risk equation upside down. That's what comes next. Here's the amateur problem, the one that destroys more accounts than bad analysis, bad timing, or bad luck combined. They think the first trade must be right, so they make it big enough to matter, big enough to feel meaningful, big enough to convince themselves that they're committed, courageous, or confident. But the professional's mindset is the complete inversion of this emotional reflex. The first trade isn't a bet, it's reconnaissance. It's the equivalent of tapping the ground with your foot before taking the next step on a dark road. Livermore always sent in what he called a test lot, one small unit, a position size so tiny it barely registered on his emotional dashboard. He did this not because he doubted his read, but because he respected the market's capacity to fool, fake, and frustrate. A test lot is not an attempt at profit, it is an attempt at clarity. You aren't trying to predict the trend. You're trying to confirm the trend's willingness to reward you if you eventually choose to size up. Imagine two traders entering the same setup. The amateur sees a chart that looks perfect, so he buys a full position instantly. The moment price wiggles against him, his heart rate jumps. His stop is wide because he needs room, which means his anxiety is also wide, and each tick becomes a referendum on his intelligence. His sense of identity, competence, and self-worth is being judged by the tape. Now he's watching the market not to understand it, but to survive it. He can't read what's happening because he's too busy reacting to what's happening. But the professional buys 10% or less of what he ultimately intends to hold. The market wiggles against him. Nothing happens inside him. No fear, no drama, no identity crisis. He's watching for behavior, not hoping for salvation. He's studying the way the pullback forms, The way the tape hesitates, the way the candles compress or expand, the way volume shifts, the way the market reveals the intentions beneath its surface. When the market snaps back the right way, that's information. When it doesn't, that's also information. Professionals don't enter to win, they enter to learn. That is their structural advantage. And here's the protocol, the simple but brutally effective rule that almost no amateur follows. If your scout survives, only then do you earn the right to add size. Only then do you graduate from reconnaissance to engagement. Only then do you begin to shift from observation to participation. This is the part amateurs never understand. Small size isn't weakness, it's armor, it's clarity. It's the shield that protects your mind from noise, panic, and forced interpretation. The scout tells you whether you're early, whether you're wrong, or whether you're on the brink of a powerful move that hasn't yet revealed itself to the crowd. It's your tape-reading instrument. Because you're risking almost nothing, you have the luxury of time, and time is the most underrated advantage in all of speculation. With time, you can watch the market breathe. You can see if the structure holds. You can detect whether sellers have conviction or are merely testing. You can see whether buyers step up at logical levels or run away in hesitation. You can see whether the trend is ripe or immature, whether momentum is authentic or deceptive. Amateurs never see any of this because they never give themselves the room to witness it. They are emotionally maxed out from the first moment. This is why the maxim professionals live by test first, size later, is not just a tactic, but an identity. It separates the trader who needs to be right from the trader who needs to understand. It separates the trader who predicts from the trader who listens. And it leads directly to the next question, the loop we opened earlier, and the one that every beginner misunderstands. Why does this small, almost trivial entry often lead to big returns? How can something so tiny become the seed of something so significant? The answer lies in what the market reveals after the scout enters. The scout is not designed to make money. It is designed to detect behavior. When the market behaves well, the professional adds. When the market behaves poorly, the professional exits for pennies. But here's the brilliance. A small risk allows you to sit through the early instability that often precedes the very trend that amateurs miss. The early phase of a trend is noisy, deceptive, filled with fake-outs, hesitation, and retests. Amateurs who size big get shaken out in this noise. Professionals who size small observe the noise without being consumed by it. And because they observe it, they're still present when the noise resolves into a clear directional movement. This gives them a structural advantage measured not in dollars but in insight. When the tape begins to behave, when the pullbacks become shallower, when the volatility contracts in your favor, when the market demonstrates that it's ready to trend instead of churn, the small scout becomes your green light. You add not because you're excited, but because the market proved itself. You increase size, not because you want to win, but because the tape has earned your commitment. Think of it like building a bridge. Every additional piece of size must be supported by new structural evidence. No evidence, no bridge. Amateurs dump their full bridge into the void and hope the market constructs the foundation afterward. Professionals build the foundation step by step, letting the market show them where the load-bearing points are. This is why the scout entry is the beginning of wisdom, not the end. It's why the first trade matters less in dollars and more in information. It's why professionals can survive periods of chop, noise, and uncertainty that crush amateurs. The scout is the frictionless opening move. It opens your eyes instead of closing your system down. It opens the door to proof instead of prediction. It opens the path to scaling instead of scrambling. It is the first move in a dance with the market, where the market sets the rhythm, and you follow its lead. And that leads us to the emerging loop. How does the market invite size when the real trend is about to begin? What signs appear that tell the professional to move from 10% to 30%, from 30% to 60%, and eventually into a full position? What happens in the structure of the tape that transforms a reconnaissance step into a full campaign? That is the architecture we explore in the next chapter, the moment when the market shifts from random walk hesitation to directional authority, and the professional, calm and lightly exposed, sees the invitation before the crowd wakes up. Most traders believe trends arrive suddenly, but professionals know trends whisper long before they shout, and the trader who learns to hear those whispers captures moves others only dream about. This is where the puzzle begins to close, where the logic behind the scout, the light entry, the almost laughably small initial position, finally reveals its true purpose. The scout isn't the trade. It's the antenna, the instrument, the early warning system. It tells you not what the market is supposed to do, but what the market is preparing to do. If the market wants to move in your direction, it won't behave randomly. It won't drift aimlessly. It will tighten, stabilize, compress, and then begin to push in your favor with a subtle but detectable rhythm. This rhythm is what Livermore trusted more than any prediction, any analyst, any opinion. He trusted behavior. He trusted how the tape reacted to pressure. He trusted the signature of strength. And when that signature appeared, he knew the invitation was real. The invitation is not a breakout or a sudden spike. That's too late. The invitation is the series of higher lows that show buyers quietly absorbing supply. It's the reduced volatility against your position that signals sellers are exhausted. It's the volume that expands on upswings, but contracts on pullbacks, telling you the path of least resistance is upward. It's the pullbacks that fail to break structure, creating a staircase of strength. When your tiny scout sits calmly inside this tightening coil, it becomes your compass, your anchor, your decoder ring for the market's intentions. You're not predicting anymore. You're listening, and listening traders survive. Predicting traders perish. So here's a simple, almost mundane story that reveals the entire difference between an amateur and a professional. A trader sees a stock coiling beneath a major resistance line. The chart looks perfect, clean structure, strong momentum, a textbook pattern. The amateur sees the pattern and immediately buys full size because the chart should break out. But the market isn't obligated to obey his timing. The stock dips first, shakes out weak hands, produces a false flush before its real move. The amateur's oversized position hits his pain threshold instantly. He panics, sells emotionally, and watches in disgust as the stock snaps back and launches without him. He wasn't wrong. He was early. And because he sized big, early became fatal. Meanwhile, the professional is watching the same setup. But instead of committing heavy size, he sends a scout, a tenth of a typical position, a number so small it barely registers on his emotional radar. The dip occurs. The scout loses a trivial amount. Nothing changes. The professional watches. He observes how the stock behaves under stress. It refuses to break down. It shakes a little, then firms up. It holds a key level. It snaps back. That snap is not luck. It is the tape revealing the presence of accumulation, large buyers absorbing every dip, strong hands patiently building a position. That is the invitation. And only then, only after the market proves itself, does the professional add. First, small to medium. The market behaves. Then medium to full. The market strengthens. Each addition is justified by evidence, not hope. This is pyramiding done correctly, a practice so misunderstood that amateurs treat it like reckless aggression. But true pyramiding is not cruelty to your account. It is the most disciplined form of alignment between capital and confirmation. As the market earns your trust, you let your capital participate. If the market stops earning your trust, you stop adding. It's that simple. The maxim professionals live by becomes obvious here. The market pays those who wait for proof, not those who guess, not those who hope, those who wait. And the scout is the waiting mechanism. But here's the twist that most traders never consider. Even when the confirmation appears, even when the behavior shifts, even when the invitation is undeniable, the professional does not relax. In fact, he becomes more vigilant, because he understands something most people never learn. Your stop matters more when you're right than when you're wrong. Think about that. When you're wrong, the stop saves you from a mistake. But when you're right, the stop protects the early position that will eventually anchor the entire move. Your initial risk is tiny, and your stop is clear, so there's no fear. But once you add once, the market confirms. Once you size in, that stop becomes the guardrail that protects the structure you're building. Amateurs think stops are only for bad trades. Professionals know stops protect good trades from becoming disasters. And this is where the psychology of confirmation deepens. When your scout is working and the market begins to show its hand, you feel the temptation to relax. You feel the urge to think, it's safe now. But that exact moment is when complacency destroys even skilled traders, because they confuse confirmation with certainty. Nothing in the market is certain. Confirmation is merely the market saying, I may move your way. Not, I guarantee I will. That's why professionals treat confirmation as an invitation, not a promise. They add size. Yes. They press. Yes. But they also slip a safety net beneath the entire structure. This safety net is not an optional accessory. It is mandatory. Livermore believed that every trade, every single one, required a protective mechanism. Not because he expected failure, but because he respected uncertainty. And this respect for uncertainty allowed him to sit through the noise without letting the noise consume him. Now, here's where the paradox intensifies. The stop does not only protect you from being wrong, it protects your ability to exploit being right. Because a trend is never smooth. It will challenge you. It will fake weakness, fake strength, produce volatility to test the conviction of participants. Without a structure, scout, confirmation, additions, and stop, you won't last long enough to reap the rewards of the real move. And here's the deeper truth that professionals internalize. The market reveals its strongest moves only after it has shaken out those who size too big too early. Your small scout is designed specifically to survive that shakeout. Once it survives, confirmation arrives. And once confirmation arrives, the real game begins, letting the position grow without letting your emotions grow with it. Professionals understand that the early part of the move belongs to the market, the middle part belongs to the disciplined, and the final part, the part that makes the entire trend worthwhile, belongs only to those who protected themselves from catastrophic loss while pressing advantage with maximum precision. All of this traces back to a simple principle. Trends emerge through behavior, not prediction. You don't need to know the future. You need to read the present correctly. And the scout gives you the emotional distance required to read clearly. Once the behavior confirms, your additions become natural extensions of the market's own momentum. You're not fighting. You're flowing. You're not imposing your will on the market. You're aligning with the energy that's already unfolding. But this flow still needs guardrails, because no matter how clean the move looks, the market never stops hunting the undisciplined. Which leads to the most counterintuitive truth of all, the one that sets up the next chapter. A great trend rewards the patient trader, but only if that trader respects the one tool amateurs treat as optional, the stop. And the stop becomes more important not when your trade is losing, but when your trade is winning. Because a winning trade without protection is nothing but a future loss disguised as success. And that's the paradox we unravel next. Most traders fall apart right here, at the exact moment when the market demands their deepest discipline, because they misunderstand what a stop truly is and what role it plays once a position begins to grow. They think a stop loss is simply a line that says, if I'm wrong, get me out. But professionals know something far more powerful. A stop loss protects your ability to stay right. When you begin with a scout, add on confirmation, and pyramid, as the trend proves itself, you're doing more than building a position. You're increasing exposure, layering risk, constructing a tower of capital that will only stand tall if the foundation remains untouched. Your initial safety line becomes sacred. It is the point at which the trend would be invalid, not where your nerves start screaming. And this distinction is the divide between traders who survive and traders who implode. Because every giant market move, every legendary runaway trend that later looks smooth and obvious on a chart begins with chaos. It begins with messy pullbacks, deceptive reversals, violent shakes, sudden tests designed to flush out everyone who doesn't truly understand structural risk. If your stop is sloppy, emotional, random, or placed at some convenient round number, you get removed from the stage before the performance even begins. Livermore's principle was brutal in its clarity. Your stop must live where the trend itself dies, not where your fear becomes uncomfortable. And fear always becomes uncomfortable long before a trend ends. Here's an anecdote that plays out in every market, in every era, across every asset class. Two traders, pyramid into the same winning trade. Both began with scouts, both added only after confirmation. Both now sit inside a promising trend. But their thinking diverges at the exact moment discipline matters most. The amateur tightens his stop aggressively because he's afraid of giving back profits. He wants to protect what he's gained, but he doesn't realize that by choking his stop too close to the noise, he is protecting the wrong thing. He's guarding short-term comfort instead of long-term opportunity. A wiggle comes, a sharp dip, a shakeout, engineered by the market's natural rhythm. His too tight stop gets tagged. He's out. His profits vanish. Worse, his conviction is shattered, and his mind becomes poisoned with regret. He's now emotionally paralyzed, unable to re-enter even if the trend resumes. And of course the trend does resume. It launches. It accelerates. It becomes the very move he believed in, but can no longer participate in. Meanwhile, the professional keeps his original structural stop untouched. Not because he is reckless, and not because he enjoys risk, but because he respects the architecture of the trend more than the random noise created by intraday traders, algos, market makers, or short-term positioning games. He knows the difference between noise and structure, between fear and invalidation. The dip holds above structure. The trend stays intact. He remains calm. He watches the tape with clarity rather than panic. And when the next breakout arrives, he adds size again, aligning with strength rather than fleeing from weakness. He rides the move the amateur was shaken out of. He participates in the part of the trend that delivers the real profits, the part that turns skillful positioning into exponential gains. And this simple divergent stop placement based on fear versus stop placement based on structure decides the fate of traders, far more than entries, chart patterns, or indicators. The maxim that emerges from this is deceptively simple. Stops protect your profits by protecting your conviction, because profit doesn't come from being right once. Profit comes from staying right long enough. It comes from enduring the grind, the wobbles, the tests. It comes from letting time do its work. A good trade rarely goes straight. A good trade challenges you. A good trade punishes those who size too big, too soon, or who have placed their exits where emotional discomfort lives instead of where structural failure lives. And this leads naturally to the question that closes every loop we've opened so far. The question that traders ask silently, even if they never say it out loud. If you start small, scale only on confirmation, pyramiding like a professional, and use a structural stop that guards the integrity of the move, how do you know when to hold for the massive trend versus when to begin taking profits? When do you sit? And when do you cash out? When does patience serve you? And when does patience betray you? It's the final piece of the Livermore hack, the last paradox of trend trading, the part of the game that separates those who catch the middle 80% of a move from those who grab the first 10% and bail, terrified of giving back gains. The answer is not emotional, and it's not based on greed, or fear, or some mystical intuition. It's based on the same principle that guided everything up to this point. The market must earn your action, just like the market must earn your initial position through confirmation and must earn your additions through structural behavior. The market must also earn your exit through deterioration of the trend. Professionals don't sell because they're up a lot. Professionals don't sell because they're afraid the move can't go further. Professionals sell because the trend they're riding begins showing symptoms of exhaustion, lower highs, widening volatility on rallies, flattening momentum, heavy distribution volume, failed attempts to resume strength. They exit not because of profit or fear, but because the market has stopped rewarding their presence. And here's the deeper truth that most amateurs never learn. Exits are the mirror of entries. You don't predict them, you read them. You don't choose the top. You observe the top forming. The same quiet behavior that confirmed your entry will later warn you of the trend's decay. But none of that means anything without the stop that preserves your position long enough for those signals to appear. Without a structural stop, you never stay long enough to require an exit strategy. You are shaken out before the real battle even begins. And that's why stops matter more when you're right than when you're wrong. Because being wrong costs you money. But being prematurely shaken out costs you opportunity far more expensive in the long run. The great irony is that traders obsess over entries and targets. Yet the real money is made in the middle. And the only way to stay in the middle is through a stop that guards your conviction instead of your fears. With each addition, your exposure grows, but so does your confidence provided the structure remains intact. And that structure can only remain intact if your stop lives at the place where the entire logic breaks, not where you start feeling uncomfortable. Amateurs ask, how do I keep what I've made? Professionals ask, how do I stay aligned with the trend as long as the trend is alive? Different questions, different mindsets, different outcomes. And now the stage is set for the finale. Because once you understand how to start small, scale only on strength, anchor your risk with a structural stop, and protect conviction instead of comfort, you arrive at the ultimate question. How do you hold long enough to catch the move that changes everything? That's what comes next. Here's the final secret, the one every trader senses in their bones, yet rarely puts into words because it runs against every instinct, every impulse, every piece of emotional conditioning that markets ingrain into the inexperienced. Catching the biggest market move is not about prediction, or timing, or brilliance, or some mythical feel for the charts. It is about endurance, pure and simple. And endurance is only possible when the structure beneath your trade is strong enough to hold the weight of your patience. Endurance does not come from confidence. It does not come from certainty. It does not come from conviction created in your mind. Endurance comes from engineering. You create endurance by starting with small initial risk that keeps fear quiet. You reinforce endurance by adding size only when the market confirms your direction. You protect endurance by keeping your stop at the structural level where the trend breaks, not the level where your stomach flips. And once this architecture is in place, you arrive at the question that haunts every trader who has ever tasted a small win and wondered if it could have been a life-changing win. How long do I hold? It sounds simple, but it is the most psychologically demanding question in trading. Livermore never answered this in theory, because theory is too fragile. He answered it through behavior, through process, through unwavering discipline. You hold as long as the tape behaves. That is the entire philosophy compressed into one sentence. Professionals treat waiting as a position. Amateurs treat waiting as anxiety. This is the final identity divide, the one that determines who will exit early and who will stay long enough to catch the part of the move that makes the entire strategy worthwhile. Consider the scenario that plays out thousands of times across markets, time frames, and decades. A trend begins forming, the kind that doesn't shout but whispers. Your scout enters. It survives. The tape cooperates. You add size. Confirmation arrives. You pyramid with discipline. The market respects your alignment. You're positioned well. And then, just when your excitement peaks, something uncomfortable happens. The market pauses. It stalls. It chops. It goes sideways. It retraces in a way that feels like erosion, not destruction. For the amateur, this is unbearable. They feel the urge to lock gains, because they fear losing what they have rather than imagining what the structure might produce if they allow it to mature. They exit, feeling proud of their discipline, unaware that they just cut down the tree before it sprouted fruit. The professional acts differently. When the pause comes, he doesn't ask, "Am I about to lose money?" He asks, "Has the trend broken?" And if the answer is no, he sits. He waits, He observes. He endures boredom, uncertainty, the hum of doubt that enters the mind during consolidation. He survives the psychological storms that blow most traders off the trend long before the big move even begins. Because here's the paradox. The biggest part of the move, the explosive section, the runaway trend, the vertical push that makes the trade unforgettable, comes after the moment you most want to exit. The emotional low point almost always precedes the financial high point. Your mind becomes anxious right before the market becomes generous. And that is why most people never experience the miracle of a true trend. They exit during the consolidation because they cannot distinguish discomfort from danger. They think the pause means failure. They interpret silence as reversal. But professionals understand that pauses are not failures. Pauses are breath. Trends inhale before they exhale. Structure tightens before it expands. Price compresses before it accelerates. The markets are organisms, and organisms rest before they grow. So the final maxim emerges with clarity. Hold until the market proves you wrong, not until you feel uncomfortable. This closes the loop that began in Chapter 1, when we spoke about the paradox that traders miss the big move not because they are late, but because they take so much risk up front that they cannot survive the emotional journey required to catch it. If your initial position is too large, you cannot sit through the pauses. If your additions are reckless, you cannot sit through the retests. If your stop is emotional, you cannot sit through the tests of structure. If your conviction is built on hope instead of confirmation, you cannot sit through the boredom that precedes the breakout. Everything collapses without structure. But when your initial risk is tiny, when your sizing is earned, when your stop is structural, and when your conviction emerges from the tape rather than your imagination, you gain the ability to do what amateurs cannot: sit through the part of the market that feels like nothing is happening, even though everything is happening. You sit through the quiet. You sit through the chop. You sit through the subtle higher low that no one notices. You sit through the declining volume that precedes expansion. You sit through the indecision that precedes clarity. And then, when the trend resumes, you are still there, aligned with strength, positioned with size that grew organically rather than emotionally, anchored by a stop that guards structure rather than fear. This is how the big move is caught, not through calling tops or bottoms, not through heroic timing, not through genius, through structure, through endurance, through the ability to remain present long enough for the trade to reveal its full potential. And here lies the ending paradox. The traders who catch the biggest moves are not the traders who seek the biggest moves. They are the traders who follow the process that makes catching those moves possible. They start small so they can survive. They scale slowly so they can think clearly. They place stops structurally so they remain aligned. They wait through consolidation so they don't surrender their place in the trend. They hold until the tape breaks, and not a moment earlier. And when the move finally extends, when the market finally delivers the large, powerful runaway trend that only emerges after endurance has been tested, they aren't surprised. They aren't shocked. They don't feel lucky. They feel prepared, because everything they did was designed to create the conditions that made the final move inevitable. This is the Livermore Hack in its final form. Not prediction, not brilliance, not special insight, just structure. Structure that creates endurance, endurance that creates opportunity, and opportunity that becomes profit only because the trader was alive long enough to experience it. This completes the entire system, the full circle of logic that turns fear into patience, patience into structure, and structure into profit. If you can internalize this, your trading will transform not into certainty, but into survival, not into speed, but into longevity, not into flashes of success, but into a repeatable process. Because in the end, the market rewards those who endure, and only structure makes endurance possible.